But my name is Greg Michalowski, and I'm happy to be here with the FX Street webinar. Today's date is August 14th. I'm going to talk to you about retail traders' top 10 most common trading mistakes. Before I get started, let me remind everybody that trading foreign exchange carries a high level of risk and may not be suitable for all investors. In addition to that, leverage creates additional risk and loss exposure should you decide to trade foreign exchange. Carefully consider your investment objectives, your experience level, your risk tolerance. You can lose all or part of your risk capital, so be aware, be prepared. Who am I? My name is Greg Michalowski. I've been working in the financial markets now for 28 years, 15 years in the institutional side as an interest rate trader for Citibank and Credit Suisse First Boston, 13 years with FXDD. After that, the first 6-7 years was mainly focused on risk management. It's a little different than the trading that you do from a retail side, but still same idea. And over the last 5 or 6 years, I've been with you as a forex analyst, an author of a book called Attacking Currency Trends. And take this website down. If you can remember the name, attackingcurrencytrends.com. That's my website. You can order it. And if you use the promo word promo, P-R-O-M-O, at the end, you will get $6 off, cheaper than Amazon. And I've had a lot of people take advantage of that over the last few weeks. Other things about myself is now I'm on my own. I'm starting my own forex consulting firm, getting that all set up and started. There's a lot more than you think. Called GregMikeFX, and that's up here, GregMikeFX. My game plan is to bring what I have accumulated, my voice, over the last 28 years, throwing away the bad, keeping the good, and packaging it up. And if you wanted more information about that, you can go to my website at GregMikeFX. I also blog there daily, so feel free to join me there. So we can, yeah, sure, I'll put that in www.attackingcurrencytrends.com and www.fx.com. And I'll send this to all attendees. There you go. So there you go. 2 links that you might be interested in. Can you hear? Is the webinar starting? No audio? Yeah. Everyone can hear, right? Yeah. Yeah, of course can. All right. All right. I'm going to start off with a couple quotes here. And the first one is, there still is a lot to learn, and there is always great stuff out there. Even mistakes can be wonderful. Even mistakes can be wonderful. That's one of the quotes. The second quote is, what's right is what's left if you do everything wrong. Both of these quotes talk about mistakes, about making mistakes. And we all in a trading environment make mistakes. But these words were not uttered by someone in the trading world. They're uttered by this man, Robin Williams, who made a lot of mistakes in his life, folks. And some of them, I'm sure he learned from them. Others of them he couldn't get over. And it's a sad thing when you know the mistakes that may be plaguing you, and you have trouble getting over them. And so that's a focus here today. And if I could dedicate a webinar, it would be to this man who made us laugh in his own way. From a historical and statistical perspective, most traders lose money. We know that the statistics show that most traders will lose money. They lose because they don't embrace the fact that Robin was trying to tell us, that mistakes can be wonderful, and that they chose not to learn from those moments of mistakes where they could take themselves and learn from them. So my focus here today is try to give you what I have seen through my career at the mistakes that a lot of retail traders, myself included, have made it and probably still do make to this day. I do admittedly, and we just have to try to minimize those mistakes. So I'm going to count them down. They're really not in any specific order, but I'll try to get through 10 of them here. So I got to go. So one of the first mistakes that retail traders tend to make is they think that trading is easy. How many of you think that trading is a 50-50 proposition, that either the market's going to go higher or the market's going to go lower? A lot of retail traders come to me and, well, you know what? Hey, I can buy here and it's going to go higher. I'm going to make money. I'm going to sell here and it's going to go lower. And what is so hard about that? And a lot of history tells us that there are bets, easy bets out there that end up being the old sucker bets. Here's the video of that I found online of the 3-card Monte. We all familiar with that game. If we live in the city, where you go and you try to pick the card, you put your money down, and you end up like this guy, disappointed. I cannot believe that the market, that the white button or the card is not where I thought it was. There's all these sorts of sucker bets out there, and you're trading as well, and make it not easy. And we also know that history is full of upsets that are unbelievable. This is one of the ones that I remember as a youth back in 1980, the Olympics, the U.S. Beating the Russians. And what made this so improbable and made me, made the announcer of it say, "Do you believe in miracles?" The miracle and the unbelievable thing about this was that it wasn't easy. These were amateurs who were going against professionals. And aren't we as retail traders amateurs going against professionals? So in a way, we have to rise like that team and beat the professionals. No offense to our Russian friends who are on the other end of that loss. But anyway, trading, mistake number one is a lot of traders think that trading is easy. But trading can be as confusing as a 3-card Monte game, believe me. There are a lot of things going on within a market at any one time that can make it very confusing, and you get mixed up. And trading can be as improbable as the U.S. beating the Russians in a hockey game as well. And I remind everybody of other instances of why trading is not so easy. And I ask those who thought that the bond yields would be moving up in 2014. What do we know about 10-year bond yields today? Breaking through the 240 level. All this through tapering and all that other stuff. It's not going away. The yields are continuing to go down. Also, German bonds went below 1% here today. Who would have thought that? 10-year German bonds, 10-year German bonds. As though, and Spanish and Italian yields are also 10 pips or 10 basis points away from U.S. yields. Who would have ever thought? Ask those who thought the euro was going below 100. Remember those days during the Greek banking crisis and all? Euro's going below 100. Easy bet. Doesn't always happen that way. Ask those who called the reversal of the stock market. No way the stock market's going to go down, especially here in the United States, or that they're going to continue to go up. They're going to go down. Ask those who called for hyperinflation because all the money that's being printed is going to create hyperinflation. And maybe down the road, maybe the stock market will indeed go down. Maybe hyperinflation will occur, but there are other things that are fighting against that. So for those people who think that trading easy, the solution to me is that if you want to be good at trading, you need to check that ego at the door. You need to say that, admit that trading is not easy, that you need to learn and understand what is going on in your mind. You need to control that. You need to understand and control things like fear and greed. You need to understand that that the bet you make is not just a single red for up or a single black play for down, like you're trading at the roulette wheel. This is not the case in trading. You need to understand who is in control in the market. If you know who's in control, then you have a better chance of benefiting from that, from jumping on that control. Understand that. You need to know how to play the game that will beat the best. That will beat the best. Even if you're a retail trader, even if you're an amateur, you have the opportunity to beat the professionals or at least play their game. And who knows what will happen at the end of that game. You may just win. Trading is not easy, but it is not impossible either, friends. But you do need help. You do need help. And that's what I'm there for. That's what other people are there for. And if you believe that, and you get our help, come to these sessions on FX Street. You are going to be you're going to benefit from that. So trading is not easy. Don't ever think it is. Number 9, even though it is thought to be easy, traders tend to overcomplicate their trading and analysis. That's another common mistake that I see from retail traders. So on the one side, I have retail traders that say, this is easy. This is a 50-50 proposition. On the other side, they then go out and complicate everything, make it so that things are not really easy to work your way through. And I think this one is a part of human nature. Human nature makes us think that the more you know, the better you will become. The more you know, the better you will become. And in most cases in life, that is the case. You graduate from high school, you go to college, you learn, you spend 4 more years educating yourself. You are going to be better off, and the statistics show that through job placement and all. It doesn't necessarily mean that you're going to be the richest in the world or whatever, but the tendencies and the statistics show that you're better off with the more education you know. But that's not necessarily true in trading. Knowledge is good, but you need to simplify that knowledge to what is really, really, really important. So traders may go out and they may buy The Death of Money. This is I just went to Amazon.com and looked up different books there. And the number 1 selling book under foreign exchange is The Death of Money, and get all fearful about where the dollar, the pound, the euro, I guess they're all going down, which is, just in and itself something that will not happen, but we know that fear sells books. And so The Death of Money is out there. And then Raimundo has an ebook out there talking about candlesticks, a 17-page book or whatever that you can get for 99 cents on Amazon.com. You can buy that and educate yourself. You can call yourself a dummy and get Currency Trading for Dummies, or you can get Kathy Lean's little book of currency trading and understand little fundamentals that apply to that. By the way, I like that book. I like Kathy a lot as well. I have nothing really against any of these books, but to be honest with you, I haven't read all of them. But like this book right here, George Soros, I don't think I'll ever read. But again, turmoil, fear, cloudy skies, it's kind of this one. These are both the one and the same. Or you can do what Robert Kiyosaki, who is I don't know if anyone knows who he is. He's the author of Rich Dad, Poor Dad, and that whole series of books. And someone sent me this picture. Says, "Hey, look, your book is in his pile of books there that he reads." And indeed, Attacking Currency Trends is there. And just to prove that when I do these webinars and set them up like I did last night, the next day, this morning, the first tweet that I read was from a guy named Matt, who's from Singapore, and he said, "Attacking Currency Trends, one of the most important books in trading. FX, thank you, sir. Really all you need, book suggestions." So anyway, you can simplify things, get Attacking Currency Trends. Of course, that's a shameless commercial. I apologize for that. But as far as complicating things go, these are 2 charts that actual people sent to me. The first one on the left is from an actual person very close to me. As a matter of fact, it's a stock chart that my dad and I were talking about, Celgene, and he sent me his chart on Celgene of what he looks at. And this was it. And coincidentally enough, the colors on his chart right here are very similar to the colors here that someone else had sent me of a chart that they put together with all sorts of moving averages, I don't know, Ichimoku clouds and RSIs, and you know, they're almost one and the same, and I'm kind of shocked at but this is what I talk about being overcomplicated. When you overcomplicate things in your trading, folks, you are not going to be trading well, okay? You're not going to be thinking clearly. You're going to be having conflicting signals. You're going to be having doubts in your mind because of those conflicting signals, and you're just not going to do well. Overcomplication is a common mistake because people want to appear smart. You don't need to. All you need to do is appear very simple, okay? So this is my very simple chart of the euro versus US dollar. And what this simple chart tells me is that right here, when the market came down and corrected up, we corrected up to the 38.2% retracement level. And right at that level also happened to be this blue line, which represents the 100-hour moving average. We're on an hourly chart right here. So not only did you have the 38.2, but you had the 100-hour moving average. You don't have to be complicated in seeing that resistance level is a key level, and you could probably put your stop right above here around the 50% retracement level and risk this amount on the trade, and in the hopes that the market goes down. Now, of course it does, and of course I picked an example that shows that, but the fact remains at this technical level, these tools that I use showed that level. And if I'm going to trade, if I'm going to be up, if I'm going to be trading at this time and I see this development right here, and maybe I don't get in right here, but maybe I get in on this bar right here when the market starts to come down. Why? Because I can always define my risk against it, 38.2 and this 100-bar moving average. And I can get in here, and the reward outpaces the risk that I take on a trade. Of course, there are going to be trades that I lose, but I'll still only lose a little compared to making more than a little. Here's another example right here where the market comes down. We find a ceiling here. We find a ceiling right here. And what's in the area here as well? Now the trend line, now we have the 100-bar moving average. Again, it's behind that number 2 right there. But the 100-bar moving average is there, the blue line in the chart, and the market sells off again down here. At this point right here, maybe you think the market's gone too far and you see low or higher lows here. And maybe, just maybe, you buy it for why? Because risk can be defined against these lows right here. And if you're right, the market has a potential move higher. If you're wrong, you lose a little. Keep it simple, folks. All you have to do is use your eyes. Look for levels 1, 2. Now we have 3. Now we have the trend line right here. We have the and that may give you a clue, and this may give you a clue right here where the 200-bar moving average, that's the green line in the chart, comes together with the trend line right here, and that's a nice level to sell against as well, and don't need to be complicated there. Over here we find new bottoms and stuff. It doesn't have to be hard, folks. Don't overcomplicate your trading. Keep it simple to be successful. The KISS principle. Thank you, Boyke, for reminding that. It is a simple moving average there, Mrs. Mark C. I almost called you Mrs. C. But it is a simple moving average, 100 simple moving average and 200 simple moving average. If your moving averages look a little different than mine, it may be because your broker opens up before 5 p.m. on Sunday, the forex trading day, and what most people follow in the institutional market and the real market is a moving average that starts at 5 p.m. on Sunday night. So be aware of that. May be a little different. May want to talk to your broker about that. All right, let's move on here and take 100 simple moving average for both. Okay. The next mistake that a lot of people trade is they don't create a base, a foundation for their trading. They don't have a mission statement. They don't have a game plan for your trading. This is not going to talk about technicals here. This is just talking about what am I trying to do. And my question to you, and whenever I get in front of an audience and speak to them directly, is: do you have a mission statement or game plan for your trading? And invariably, more than half of them don't. And if you don't know what your mission is, you won't know where you are going or how to get there. If you have no direction, you have you think you're going this way or that way or that way or that way, and you ponder which way am I going? How am I going to do this? Where am I going to go? Do I go that way? Do I go this way? I don't know. So the mission statement, folks, tells me what I am trying to do as a forex trader, and that's most important, folks. You need to know what you're trying to do. So I'm going to give you my mission statement, and I hope you follow it and build off of it. It's a base, a foundation for you to go forward in your trading. And the mission statement for forex traders, for me, is twofold. One is to make the most amount of money with the least amount of risk. Yes, I want to be sitting on a bunch of coins over there in the background, but in the foreground, I want to be focusing and measuring my risk. Notice how both of them are kind of at odds with each other, but they balance out. They're the checks and balances of a trader. You have to try to do both. So let's talk a little bit about making the most amount of money. Now, when I say making the most amount of money, it doesn't necessarily mean that you're going to make a ton of money like this picture implies, to be honest with you. We all have different skills. We all have different mindsets. We all have different abilities. And the fact that, whatever percent of people lose money in the foreign exchange market, a lot of them just don't have the aptitude to become a trader. They don't have the patience. They don't have the nerve, they can never get over, or the consistency. They're not disciplined in their trading. But you should all have a focus when you start off as traders or be a traders that you are going to try to make the most amount of money. And the next question becomes how, and that comes in the game plan portion of the mission statement / game plan, this number 8, okay? Most retail traders don't have a mission statement. They don't have a game plan, so they never get to that point of how they're going to make the most amount of money. But rather than flush the money down the toilet by not having a mission statement or game plan, have one. First part, make the most amount of money with the least amount of risk. The second part is with the least amount of risk. You as a trader need to make sure that you measure your risk, that you understand what your risk is at all times. And I got a tweet. Actually, I didn't get a tweet. I saw a tweet come out by Dr. Andy Baldwin. He's a Navy doctor. And he said this in the tweet, and I was just watching Twitter, and I saw it, and it caught my eye because I'm big on risk, folks. I'm big on risk. Life is all about taking risks. If you never take risks, then you'll never know what you're capable of. And quite frankly, on the surface, I think if you said that to 100 people, that 100 people would probably agree with that, except maybe 99 people. Except for me, it doesn't complete the picture, okay? Risk is one of those things where, it's kind of like that macho thing where, oh, well, if you don't take risks, you're never going to have reward. Well, there's plenty of people who take risks and lose a lot of money, all right? They take unlimited risks. So I chirped in and said ... But you should also define and try to limit your risk. Otherwise, risk is unlimited. And plenty of people have blown up because of that. We just don't hear about them. You never hear about the guy who blew up because he took this risk that everyone thinks that you got to take a risk to be successful and you never know and all that other stuff. And then they blow up and then, what happens to them? So who knows? Who knows? But when I say that you have to take the least amount of risk, it is an idea that you need to define your risk and limit your risk. If you don't define your risk and limit your risk, you have unlimited risk. And unlimited risk can lead to you blowing up, and we'll never see you again in the foreign exchange market. So you need to if your mission statement is to make the most amount of money, you have to understand that you try to use the least amount of risk by defining risk and limiting risk. And if you do that, you've satisfied the requirement of that mission part of that mission statement. By definition, you've defined and limited your risk. You are now using the least amount of risk that you can accept, and that's most important. So, folks, write that down. Put it on a piece of paper. Put it on a sticky note. Attach to your screen. My goal, my mission is to make the most amount of money with the least amount of risk. Now you get to the game plan of how you are going to make the most amount of money with the least amount of risk. And the game plan revolves around trading trends and keeping fear to a minimum. They address directly the idea of making the most amount of money with the least amount of risk, keeping fear to a minimum. We'll talk about each right now. So here is the sterling versus US dollar. This market is non-trending, right? This is non-trending, but it is giving us some clues about potential trends. One, it's non-trending, so non-trending markets tend to transition into trending markets. And also, from a technical perspective, we have a nice little, and for those people who follow my blog, I had this outline for a number of days, all through here, looking for the break, looking for the move, looking for the trend. And we had a fake move to the downside here, we had a fake move to the upside here. But note how the market, for the most part, stays in this yellow area right here, within these yellow area. Most of the trading is taking place in that level, that area. I also have my 200 simple moving average, my 100 simple moving average here to give me clues. And what do we see happening here? We stay below the top yellow area, bearish. Okay, we're finding sellers. We're staying below the 100 and 200 bar moving average, bearish. The market is setting yourself up for a trend type move. And when I see something like this, and now I see the market non-trending, and I start to think in terms of trading the trends, my focus is on trading the trends. That's where most of the money is made in trending markets. It's also where most of the money is lost. I start to look for trends. And so on July 28th, I wrote this. The sterling versus US dollars today is higher on the day. The low today is also higher than the lows from Thursday and Friday. So that's not really bearish, is it? No. Here's our area here, but we've broken to the downside here. Here's our yellow area right here. We've broken to the downside, and I'm still thinking in terms of trends. I'm thinking of keeping the trends. For example, looking ahead on the hourly chart below, the pair has some pretty strong resistance at the 170.08 to 14 level. And it's hard to see, but that's this level right here. We have the old low right back here. We have the 38.2% retracement of this move to the downside. Again, it's hard to see, but follow my cursor, okay? That's right here. There's my dad. He's coming in. He's listening to me on Skype. And then you have the leg down from and the 100-hour moving average coming together right there. So because I'm thinking about trends, because my mindset is about trends, I'm thinking about these key levels that if the trend is going to stay in place, if the sellers are going to remain in control, even on the correction days right here, I am thinking sell. It's going higher, but sell. And as long as the price stays below this level right here, and we have this trend line as well. So we have the trend line, 100, 38.2, old low. How many things do you need? And so I say to myself in this, because I'm focused on the trend, that, well, the price should not go above this level. It should not go above the 170.08 to 14 level. It should stay below this level. As long as it stays below this level, who's in charge? The sellers are in charge. The trend is still intact. That is a mindset. That is my focus on trends. My focus on trends is not necessarily, although you could buy a dip and trade into the correction, but it is prove to me that you can take this trend move away from me. Prove to me that you can take. And so this is what happened here. The market it did hold against that level. The market ended up going to the downside, continuing to move to the downside. That was the power move. That was the area where you as a trader are focused on. Don't go above that level. Prove to me that you can take it above that level, you buyers. But if you can't, you're going to feel the pressure. And that, my friends, is a focus on trends. That's what I mean by it. Fear. How do you keep fear to a minimum? You define risk, you limit risk, and then you accept risk. This guy, has his feet dangling. He's got risk. That risk is that shark. You never know when the shark's going to come up to get you. But if you know the sharks are in the area, maybe this is a little, the bad example, but you need to be on the lookout for those sharks. You need to be ready for that. And if you can define your risk and limit your risk, and then accept your risk, in other words, set your stops at levels that make sense, your fear can be diffused. And now you do not have fear. So do it, right? Fear. How do you keep your fear to a minimum? Define your risk, limit your risk, and accept your risk. By the way, fear is a trader's worst enemy. If you have fear, you are not going to trade well. So the only way to get rid of fear, and this goes true in life and in trading. If you have fear of driving, then define your risk, limit your risk, and accept your risk. Okay, and that's what my son did. He was scared to drive when he was 15 and a half, getting his permit. And then he started to think about it and started to think, his mind started to program, what do I have to do to get rid of this fear? And you end up defining risk, limiting risk, accepting risk, and do okay. All right, relying on too much on fundamentals, another mistake that retail traders tend to make. Why do people rely on fundamentals? Well, because fundamentals make traders feel smart. But relying too much on fundamentals will make you poor as well. What I like to think about people who think, or the idea about fundamentals is that we all want to feel smart, okay? And if we feel smart, if you're going to be the life of the party, if you feel smart and project yourself as being smart, you're going to be invited to a lot of cocktail parties. You're going to be you'll be the life of the party. You'll be blowing the horns and all that other stuff. Why? Because people are impressed by that. If someone asks me, what do I think about the market in a cocktail party or party type situation, I'm not going to tell them about 100-hour moving average or 200-hour moving average. I will never, ever get invited back to that party. They want me to talk about the euro. They want me to talk about the problems in the U.S. and this, that, and the other, and how the euro has even more problems, and CPI is here and GDP is there and all that other stuff. And then I'm going to be the life of the party. I'll be, boy, that guy really knows what he's talking about. And you'll get invited to more parties. You'll appear on CNBC. You'll do that. They don't have the technical guy talking about this stuff on CNBC. They have the guy talking about why the price is going up and why it's going down. But the thing is about fundamentals is they don't tell you where and when you are wrong. You have your story. You stick to your story. I'm going to stick to my guns. This is what's going to happen. Come hell or high water, and then the thing doesn't turn out that way. And so you say, please, sir, can I have more margin instead? And you're begging for more margin. Fundamentals should be a secondary trading tool, folks. A secondary trading tool. You can develop a bias, but let the price and the technical tools applied to that price tell you to get in a trade. My day closes at 5 p.m. That is the official closing day of the forex day. That is when the spot day moves to a new day. So that's another common mistake that brokers tend to have, is that they close at 100 hours Greenwich Mean Time or whatever, I don't know, or 2,400 hours or whatever. It doesn't happen that way. The forex day in the professional market starts and ends at 5 p.m. All right, except on Fridays where it closes around 4, because they give themselves an hour to square everything up so that at 5 p.m. they can leave for the day, for the weekend. All right, so understand that. 5 p.m. New York time, exactly. So if your daily charts are off, that may be a problem as well. So it's all important. It's very important your charts and where they go, because the reason why charts work and why moving averages work is because a lot of people are following them. And if you're not following the same ones that other people are following, the smart money is, you're going to be left behind. You're going to be left behind. So anyway, on to this story right here. I was listening to CNBC yesterday, and there's a guy talking about how Tesla, there's oversupply of their goods and all this other stuff, and fourth quarter is going to be difficult and all that other stuff. Meanwhile, Tesla's making new highs and moving higher. And Josh Brown, who's on Fast Money, I don't know, Midday Report or whatever, he said to him, why don't you just apply a technical tool to your bearish fundamentals? I mean, he had beautiful fundamentals, but there's no denying that the price of Tesla is going to the upside. And meanwhile, so his short is losing money. But if you just applied a trend line or a moving average to that fundamental story, you're golden. You're golden, folks. So don't rely on the left side right here. Rely on the right side, the technicals, and use this as a secondary tool. Use this as your bias. I have a bias to sell Tesla. When are you going to sell Tesla? Right now? No, sell it when it goes below a 100-hour moving average or 200-hour moving average. If you think it's going to 100 from $270, you got plenty of room. But let the technicals tell you. And if the market goes back above that 100-hour moving average or 200-hour moving average, get out. But at some point, if you're right, if the fundamentals pan out, that price is going to go lower, right? So follow it, all right? Here's the sterling versus U.S. dollars. The technicals told the trader who went long here above the 100-hour moving average. You can see here I was bouncing against that. Then we had, the inflation report yesterday, and we saw this little spike to the upside. So if you went long right here, because it was the first few seconds after that, and didn't wait for it, for the move, for the price to tell you, you would get out here. You get out below the 100-bar moving average. The technicals are saying failure, move to the downside. By the way, these prices don't always just come to the 100 or come to the 200 or the 100 and do what you think they should do. Sometimes they go up and they fail. But look how it fails right here and then comes back up to it. This is the money trade right here. The failure against that, the technical level right here, that's a money trade. Here's a money trade right here, back below here. Goes lower, get out. All right. Worse than expected EU data today did not lead to a sustained fall in the euro dollar. We had GDP and CPI come out. Did the euro go down? No. What happened here? Couldn't get below the trend line here. Couldn't get below the lows. So the technicals are saying, hold on, Bessie. We're going higher, and the market ended up moving higher. Listen to what the technicals are saying. Now, if you have a bias because the euro data was horrible, that GDP is low, GDP is in negative in Germany, CPI is 0.4%, then maybe this is your reason to sell. This is the Tesla. This is my reason to sell. We're against topside trend line. What do you need to happen now? You need it to go below the trend line, move to the downside. As long as the price stays below here, the bias is to the downside. Use the technicals, folks. Use the technicals. Don't rely on the fundamentals. Technicals are the primary tool. Give oscillators too much credit. Who uses relative strength index? What's the other one? I can't remember. The stochastics or whatever. Those are oscillators that tell you overbought or oversold conditions. They cause traders to trade against the trend. The quickest way to the poorhouse is to trade on the wrong side of the trend. And the thing about oscillators and in things that, especially when the market's non-trending, here's our sterling chart right here, is they tend to get oversold quickly when they non-trend. And so here the market went below the 30 level, suggesting an oversold condition right here when the market is up here, just breaking below the trend line right here. From my perspective, this is bearish. From the RSI's perspective, this is saying, oh, we may be getting oversold, look to buy. And it's not so much that we don't get this bounce right here, that the market comes down and bounces and goes sideways right here, and you say, well, it worked right there. It changes your mindset. If you're focused on here, you're thinking, oh, well, we're going up here. Whereas I'm saying stay below this line. Stay below the 170 level, all right? I'm not saying oscillate. I'm not focused on the oscillator that's oversold. I'm focusing on the trend line that's going to define my risk and limit my risk and allow me to trade the trend. That is the mindset. That goes with that other one about the other, the trading, the making the most amount of money or whatever. So you need to trade the trends. Okay. Number 5 biggest mistake: don't or can't define risk. Too much risk. Okay, a lot of retail traders will go in when they can't define it or they don't know their risk. I have 2 simple rules. Okay, 2 simple rules of this: if you don't know your risk, do not do the trade. Okay, and the other one is, if the risk is too great, do not do the trade. If the risk is too great or you don't know your risk, don't do the trade. Will the non-farm payroll be strong or weak? You don't know. Okay, so don't do the trade. The one guarantee I can make you is there will be another trade. There will be a better risk-defined opportunity. When you go into an unemployment report, you do not know what your risk is, folks. Risk is great at that time. So another example, yesterday, right before the key release, like the Bank of England's inflation report, the event risk, the market risk, and the liquidity risk are all at elevated levels, right? They're all at elevated levels. And so if that risk is at a peak level, and you don't know what your real risk is going to be, are they going to be more bullish or are they going to be more dovish? Quite frankly, they ended up being more dovish, and I'm not sure, the market was necessarily expecting that. In any case, well, the market was up on the day, and we actually moved above the 200-hour moving average at that point, right before the release, and then sold off. But what you can do as a trader, and what I do as a trader instead, is think in terms of after the event risk is over, after the liquidity risk is back to normal, and that comes after the event risk. So after the fact. And if you prepare yourself for the trade after, you're in a much better position to define your risk and limit your risk. And so the way that I do that really quickly is by taking a look at the key levels here. So if the market is trading right here, right before the Bank of England inflation report, what do we know? We're right around the 200-hour moving average. So either the market's going to go higher or it's going to go lower. And thank goodness we have technical tools that say this level up here, where we have these highs, 1, 2, 3 highs. We have the 38.2% retracement of this move to the downside. We have the and we have the 100-day moving average, which is an overlay right here. That's this thick line right here. 100-day moving average is right there. So all these things were there. That if they're more hawkish, they're going to tighten rates. We're going to go up and likely test this and perhaps even move above that level. So if you get the opportunity to buy through here, you can put your stop right here. We shouldn't go below the 200-hour moving average. We should see the price move up toward here, and then maybe even move up to the 50% retracement. If we get above this key level right here, we're going higher. So the goal is to risk a little and potentially make more than a little. Now, the same goes true on the downside. If they're more dovish, what do we need to get below? Well, this trend line and this 100-hour moving average, those are 2 key levels. And note here that we held the 100-bar moving, or we held the trend line down here, and for the most part, the 100-bar moving average on the low as well. So if we are able to get below this level, then we have the potential to move below the low and move below this trend line and move lower still. And so by setting yourself up, you are setting yourself up for success rather than failure. Okay, and you're also setting yourself up to be able to define and limit your risk after the liquidity risk and the event risk is over. All right. So if you're able to sell in this area right here, you could have stopped right there, and that's a better trade. That's a better trade where you can define your risk and limit your risk, and you're more comfortable with that risk. You don't have the fear. All right. Let's look at the 6th or the down to the 4th. A lot of traders target 2 trade targets are too far away. What do I mean by that? Well, if you're going to put on a trade, you're going to have an idea of where it's going. But targets should be realistic levels that make sense to you, okay? That aren't pie in the sky, okay? It's okay to have that idea that we have the potential to go here, but there's going to be which is a far way away. But there are going to be a lot of steps up and down, and the market doesn't necessarily go in a straight line. So what I try to tell traders is to not look so far away. Look closer. It's much more easier to predict closer than far. And target steps, exits, if you will, that get you to your final destination as if you're driving on the highway. And this is an old one back from 2010, but this is a bunch of hedge fund traders getting together, including Soros and SAC Capital Advisors, those crooks. Not proven in the court of law, but they all got together for a dinner and probably had some nice wine or whatever. And the word was that they saw the euro moving to $1 could represent a career trade. Well, it was at 135 when they made this prognostication or whatever, and maybe it did go down a little bit. But to go from 135 to $1, that's a 35% decline or thereabouts in the value of the euro. And this is going to be difficult to do. And we're still waiting for that dollar level or whatever for the euro dollar, Mr. Soros. I got this from someone this morning, as a matter of fact, who said that he sees the euro long target being 137. Well, the euro is at what, 133 and change or something. So to go to 137, 400 pips or 300 pips or whatever from the current levels. You know what? You're getting the horse is in front of the cart there. There's other things in the way of 137. Here's the 137 level up here, right up here, and that I can see the target. Why he's seeing that, and it's this old high right here. So I can see that very clearly. But to get there, you got to get above here. You got to get above the 38.2 of this move to the downside, the 50% of this move to the downside, 61.8, the old trend line which cuts across going back a long way. Got to get above there. You got to get above the 100 and 200 day moving average, and once you're able to do that, you're going to be coming up to 137. So knowing that this may be where it goes. I'm not saying that the gentleman or the woman is wrong of where it's going, but focus more on what you can predict with a little bit more certainty, like get above this trend line. All right, if we get above that trend line and stay above that line, we have a chance to get through the 38.2. And then we have a chance to get through the 50. And you trade with much more confidence along the way. So do that in your trading as well, is make sure that you do the steps along the way, the target steps along the way, and you'll be much better focused on the trade, much more confident in your trading as well. Don't be so forward looking. It's okay to have those hopes and dreams, like in the dollar versus yen that we're going to 94.50. I heard that last week. Down here at the 38.2% retracement, that's a good level to go to. But understand that if you're going to get there, if we're going to get down to that 94.50 level, we need to get below the 100 and 200. We need to get below this trend line. We need to get below this low. We need to get below the 50%. We need to get below the 61.8 and this low and this low. And then we have the opportunity to get to 94.50. So understand the steps along the way. I'll be better off. Don't anticipate trends. A lot of retail traders do not anticipate a trend. But we kind of went through that before, where my mindset was on the trend. To enter a trend and stay on a trend is important to try and anticipate a trend. That's what I was doing before, anticipating a trend. My mindset was on the trend. So when I look at the euro versus US dollar and I see the market peaking up here at 1,234, I know that we got close to the 140 level. That's an important level. I know that we fell below this trend line right here, and we came down pretty hard off of this level. I am anticipating something happening more. As long as we stay below this level and we get below the 100-day moving average, another important level, and we get below the 200-day moving average and stay below these levels right here, we can anticipate something more. That's what I mean by anticipation. Early in the trend, try to think, change your mindset. Try to think in terms of taking the steps and staying below the steps, and you're able to make a little bit more on the trade. Same goes true for the dollar versus yen. We're in this narrow trading range. Folks, at some point we're going to go here or here. All right? And I'm going to anticipate a trend move one way or the other. So be aware, be prepared for it, anticipate it like a professional athlete anticipates. Think about it. Think about professional athletes. The best professional athletes anticipate. We have to do it as traders too. The best traders anticipate as well. Learn, anticipate. Think in terms of this got to stay below that 170 level. If it does, we're going lower. I'm anticipating a trend. Exit without a reason. We spend all this time on reasons for getting in a trade. You should also have reasons to exit a trade. Bye-bye trade. Make sure you have reasons to exit. Now, if we take a look at the New Zealand versus US dollar hourly chart, is there a reason to exit this trade on the hourly chart here? It's just a couple days ago. We're below the trend line. We're below the 200. We're below the 100. The market held the 200. It held the trend line. We're below this longer-term trend line right here. Market comes down to this low. We're making new lows. Is there a reason to exit here at the lows? And the answer is probably no if you're just taking a look at this hourly chart. But if you look at the daily chart, is there a reason to exit at the lows? And maybe there is. And so if you're going to get out of a trade, make sure you have a reason to exit. Don't just exit because we're making new lows and it's at a low level and I have this profit. Try to find some reason, folks. Try to find a reason down here where the market comes down to a double bottom, a low right here, and you have the opportunity to get out. And if you know that level, then maybe there are more reasons to get out right here where we broke above the trend line right here. We moved above that. We also are holding this trend line right here. Both these things come into play right here, and we have the double bottom off the daily chart. That is where you want to get out. That's where you want to, this is where you want to trade. There are reasons to get out of this trend move to the downside. And by the way, if you're wrong on this, if you don't get out, if the market, if you're riding the trend to the downside, wherever it comes, maybe it comes right from here and you get out right here. This is your trade right here. It's not, I'm not going to say that everyone got in right here, or everyone got in right here when it went below the whatever. But whatever trade you're on, if you have a reason to trade, make sure you have reasons to get out, okay? Reasons to get in, make sure you have reasons to get out. And if you're wrong, you're wrong when the market goes below the reasons to get into the trade. My reason to get into the trade was the double bottom off the daily chart. It was also off this trend line. So if it goes below this trend line, these trend lines, and it goes below the low right here, not too far away from that level, get out or go short. Again, reasons to trade. Trade against the trends. Most money is made trading with the trends, folks. Most money is lost trading against trends, folks. Trends are directional. Trends move fast. Trends tend to have larger trading ranges. Trends tend to correct, but corrections tend to be predictable. The benefit from the trend is gone when it's done. It's gone when it's done. So to make the most amount of money, going back to our mission statement, you've got to be focused on the trends. You have to understand that the trend is truly your friend. It's really the only friend that you have in trading. Don't trade against it if you can. Don't trade against the trend. So my top 10 most common mistakes. I think trading is easy, even though traders think it's easy. They overcomplicate their tradings. They don't have a mission statement or game plan. Get one. I gave you it. Rely too much on fundamentals. Don't rely on fundamentals too much. It's a secondary trading tool. Don't give oscillators too much credit. It messes with your mind, folks. It messes with your mind. Think, if I don't use them. It mess with my mind. And that comes from experience. Believe me, I've used relative strength. My dad uses relative strength and stochastics. He won't get it off its chart. Like, get rid of that. It messes with your mind. don't define risk, take too much risk. If a target level is too far away, that's not good for you. Use intermediate targets. Exit without a reason. Exit for a reason, folks. You make all this, spend all this time getting in for a reason. Exit with a reason as well. Well, you'll find that you're going to make more money that way. Try to anticipate trends and don't trade against the trends. Those are my top 10 mistakes that most retail traders use. All right, so that about does it. If there are any more questions, we have a few minutes here for me to answer those questions. Other than that, I want to thank you all for coming in. I hope you learned something in trading here today. If you do want this PowerPoint, I'll probably put it in a Dropbox. And if you don't have a Dropbox, just let me know in an email. But send me an email at GregMikeFX at GregMikeFX.com. And I will be happy to send it to you or set it up in a Dropbox so that you have access to that. And if you don't have a Dropbox, it's a good way for you to store things in the cloud, if you will, for free. They give you some free stuff, so do that. You say don't anticipate, and then say anticipate. Don't anticipate. I think I said, and I'm trying to get to the reference. Is that where maybe where it was like the euro's going to 137. You don't get too far ahead, and when I anticipate a trend type move, okay, you have it in the back of your mind, and you step through the steps along the way. Maybe that helps you distinguish between that. You can anticipate a trend without thinking too far ahead, is what I'm trying to say, by making sure that you target levels that are not too far away, that you target things along the way that get you going. Maybe that helps you. Maybe that's where I'm reading you or reading your comment here. But good. It was recorded as well, and it's going to be archived in a few hours at FX Street. So thank you very much. I hope that is what you referred to, or that's what you're referring to, Boyke. And I apologize if it was a bit ambiguous within my presentation. Another common mistake that retail traders do, and this seriously is a common mistake, is that my name is Greg Michalowski, and I go by short Greg Mike because it's just it's easier than having Greg Michalowski on Twitter. So you would be surprised how many people call me Mike, and but my real name is Greg Michalowski, and my nickname is GregMikeFX. That's my brand. That's okay. You are not the only one. You are not the only one. I can assure you that happens almost every day. Almost every day. So so laugh about it. And the other thing, folks, I had reference to Robin Williams, and he talked about mistakes, and he made an ultimate mistake at the end, and in the last few days, the last minutes of his life, and we have to get over our mistakes. We have to understand where we can get help and get it. All right, just get peace. Question: what time frame do you use? I use the 5-minute, the hourly, and the daily, and I apply the same tools to each of them. My 3 tools are moving averages: 100 and 200, simple moving average. trend lines, you saw them, and Fibonacci retracements. You saw some of those in the analysis. That said, I don't try to overcomplicate things. I try to keep things as simple as possible, try to visualize things. And the reason why I use those tools is they're used by many, and that's what I want to use. And so the other thing that you can do with having too many tools, like you mentioned, pivot points, okay? Yes, pivot points are good. They define your risk. They limit your risk. That's another requirement of my tools, is that they have to define your risk and limit your risk. And if they don't, then I don't use them. Like RSI doesn't define my risk and limit my risk. It doesn't tell me where I'm wrong, nor do fundamentals tell me where I'm wrong. They tell me that I think the market should bounce from here, or the market should go higher, or the euro should go lower, or whatever. Moving averages, trend lines, Fibonacci retracements, they define my risk and limit my risk. So are pivot points wrong? No, but you have to be careful that too many ingredients are going to push you over the line of conflicting ingredients, which increases your fear. And we want to stay clear of fear. Remember, our game plan is to trade the trend and keep our fear to a minimum. So all that kind of goes in together with the mission statement and game plan. So there are plenty of tools that I could use and you could use that could benefit your trading, but it could also put you over the edge to where your fear is now increased because you've replicated a tool, that you have conflicting tools. It's always best to trade with a conviction that I'm trading against the 100-hour moving average and the trend line, and that is good enough for me, rather than, but the pivot we're just above the pivot, and there you go. Trend lines, moving averages, Fibonacci retracements. That's what I use. And in my new business, I'm going to be giving more seminars that go on, that are a little bit more detail in this. This isn't the whole thing, folks, right? I spent an hour talking about 10 things. There's more digging involved in there, and you got a broad stroke brush, but I think I have something I can give you the help. All right, let's call it a day. I know the people at FX Street want to get on their way as well. So thank you very much to the people at FX Street. Thank you very much for people coming in here today. Send me an email if you want the access to the PowerPoint slides, and if you like the webinar, go to it. And if you're interested in reading my book, you can also go to that website, tacticalcurrencytrends.com. And remember, use the promo PROMO. It's toward the end of the order process. All right, take care. Bye-bye now.